Welcome to Breaking Ground. I'm your host, Devin Kulka. On this show, we meet with industry leaders in the design, construction, and real estate industries. Today's guest, Austin Walker, is a loan originator with Arbor Realty Trust. Austin's doing tremendous thing in the multifamily lending capacity, and we're really excited to have him on today. Welcome to Breaking Ground. I got an awesome guest today, Austin Walker, Arbor Realty Trust. I always tell you this face to face, but I'm going to say it to the camera so everybody knows. Best lacrosse player I have ever played against. I played against him in high school. I thought I was pretty good. Then I matched up against Austin, and you just ran right by me like I had no wheels.
That's all right. That's all right.
So how you doing?
I'm doing good. Thank you for having me.
Thank you for joining, man. You are killing the game. I follow you on social media, and I feel like you're closing something every week. It's great.
We're definitely busy. It's been a really unique year. Happy to be on one of the best platforms in the industry, and I think that's really been the major driver of it. Just happy to be here with you, and it's crazy that things come full circle.
It is crazy. It is crazy.
Going from playing against each other as competitors, and now colleagues
working
trying
together.
to do deals
exactly.
together.
I love it. I love it. So you keep talking Fannie and Freddie.
Mm-hmm.
For somebody who doesn't know what that is, break it down in the layman's terms, because
Sure.
it could get really complicated.
Absolutely, and we'll keep things simple. I mean, it's how I always like to do things. So Fannie Mae and Freddie Mac are, a lot of people say, what is Arbor? Are you a bank? If I talk to new customers, are you a broker or a bank, or what are you? So, Arbor is a direct lender for Fannie Mae and Freddie Mac. We are one of very few that are licensed to be a delegated underwriter and servicer for Fannie Mae, which means as long as we're originating loans within the Fannie Mae guidelines, we can actually originate, underwrite, and then close a loan without Fannie's prior approval. In most cases, because loans are typically tailored, there's certain requests for say interest only, or maybe you're in a market that is traditionally 65% loan to value, but you need a little bit of additional leverage. We have to go in for waivers, but outside of that, it really is, Arbor is the lender. Arbor's making the credit decisions. Arbor's handling the underwriting, and then post-closing, we're handling the servicing. Also on our balance sheet side, outside of Fannie, we really are the lender in that instance. But for agency, right? Typically, your lenders for multifamily are your banks, your life insurance companies, and then there's agency. Those are your really three major food groups for multifamily capital. But there's probably 20 something of us out there as far as the Fannie delegated underwriter servicers. Most are licensed as well with Freddie Mac. All have different sorts of profiles in the types of assets that we focus on. We're predominantly workforce housing lender, but that's what the agencies particularly like to target. That's the core.
But this is only multifamily.
But only multifamily. But the wide spectrum that is multifamily. So that consists of student housing, seniors housing, affordable housing, and market rate.
Assisted living at all?
Very selectively.
Okay.
But yes.
Okay. Now these recourse loans, non-recourse loans, each one's different.
Yeah, these are non-recourse loans. Fannie and Freddie both are CMBS products.
Okay.
But they are non-recourse except for standard industry bad boy carve-outs for fraud and misrepresentation.
And where do you see interest rates, give or take, these days?
Because of the way that they're structured, depends on the underlying indexes, where treasuries are, and then the spread environment, when indexes, drop kind of off a cliff like they did, a couple of weeks ago, and coming into COVID, spreads have a tendency to widen out a little bit, but, generally speaking right now, they're in the low to mid threes, and then just depends on every deal, again, is looked at individually. So there's, they really focus on affordable. So not to get too down in the weeds on what the affordable thresholds actually are, there's your actual what they call capital A affordable, which is half contract, LIHTC type deals, which have a reg agreement, which have real caps on rents. From a legal standpoint, those price a little bit differently, much cheaper. They go on a different grid. You have different leverage and DSCR constraints as well. But then there's also pricing waivers that are built into the sort of baseline, what we call grid pricing, which is the pricing that both agencies set kind of daily, and our capital markets group, will feed that to us. And, basically you take that grid and you look at, we run an affordability test on the rent roll. We look at, is 80% of the units at 80% of area median income or below. That'll qualify for, whatever affordability kind of hurdle that we get. So that'll take, call it 20 basis points off the grid rate. So you do get preferential pricing, right? Versus a property that if we run the rent roll, it's not affordable at all. So they really want to capture, rents that are kind of naturally occurring affordable housing, but also dominant in the manufactured housing space. It's personally something that I do, quite a bit of, which is mobile home parks, for the layman.
So you're doing stuff all over.
Mm-hmm.
I see a lot of developers in Long Island and New York City that are like, I'm done here.
Yep.
I'm going down south. I'm going to Florida. I'm going to Texas, Dallas, Nashville. Where are you seeing a lot of the money going, and is there places that you guys are attracted to lending?
So you ask a really good question, and it's kind of a challenging question, especially right now because of what's sort of happened in our industry. You talk about Dallas and you talk about Nashville. I think perennially, you could throw Atlanta in there.
Absolutely.
That have just been absolutely on a tear. Both from population growth and a number of different things, right? I know that U-Haul did some studies on, the kind of the one-way sort of transit for, folks moving. I think Tennessee and Texas were both on the number one and number two. So the great thing about where I sit is, we're working with some of the greatest, multifamily investors in the world, and, what you would call the smart money. And we are able to kind of watch those originations and where they are. And then we also look at the performance of our servicing book. We service, I guess we're right about $26 billion on our servicing portfolio, and that's across the entire country. But you can really start to hone in on, where values really are, where these buildings are actually performing. But it's starting to become much more, I don't want to say agnostic, because there really are still opportunities out there in different markets, and there's some markets that you're just driving maybe better returns. But because I'm like I said, I'm not an economist. I'm not gonna go into a whole macroeconomic sort of thing here. But what you do see is you've just been over this sort of downward trend of cap rates. And where traditionally you invested in New York, you were used to seeing 5 caps, and then we had no problem underwriting to say high 4 caps, and that was all normal, even pre-pandemic. We're starting to see those levels trickle into suburbs of Atlanta, where a 5 cap is a really good kind of going in metric. And in some, parts of, more around the cores and some of these other areas where, they were normally 6 cap markets, 5 is just something that, is commonplace. I do a lot in, say New Orleans and different parts of Louisiana, and you're just seeing some crazy prices that, 5 years ago on a price per door basis, you just kind of unthinkable, in some of these areas. And it's more being driven by, in my mind and a lot of people's minds, it's an inflation trade, and there's a lot of capital following that when you have an unprecedented amount of Fed stimulus, right? That's going to drive inflation in the future. The only way that you can really kind of get out of it is to let inflation run a little bit, which is only going to bode well for hard assets long term. So I think a lot of people don't really feel that we're unjustified into getting in at these price levels, and it's not always things are very, very healthy from that perspective. Rates are still low, even kind of pre-pandemic, we were still at very healthy interest rate levels, and household balance sheets are as healthy as they've ever been.
There's definitely a fear out there, though, that the government just pumped all this money into the economy, and there's going to be an inflation, and we're going to have a rise in interest rates, and
Sure.
um, it's something that I'm sure you got your eye on every single day. I don't know if you have an opinion on that, or
I think it's very difficult to have a true opinion on it from a couple of different standpoints. Because one, nobody knows what's going to happen, right? I think what you try to do, especially from a lender's perspective, is look around at the landscape and say, okay, well, if we're underwriting using solid fundamentals, and right, every transaction that we're doing, we're looking at the fundamental assets value. We're getting appraisals. We're looking at realistic underwriting. We've always had a pretty tough, and I think even within the industry, we're known to have a pretty tough, credit regime, and that's for a reason. We will continue to do deals when there are downturns and tough times. We still had a pretty decent run rate on originations during COVID on our balance sheet side of the business. And I think you have to just underwrite responsibly. You have to look at the fundamentals, and you have to just understand that you just have to keep that perspective, because, hindsight's always 20/20. There was a lot of fear. There was a lot of, panic around, well, will collections fall off a cliff? The eviction moratoriums, how is that going to, really, really affect multifamily? But it's proven once again throughout the last year and a half, going on 2 years now, that this sector has been incredibly healthy. I know us personally, we had one of the lowest forbearance rates in our servicing book out of anybody. So we look around saying this sector is incredibly healthy. From an inflation standpoint, some of the things that you just see generally, if you're driving around, you go to Dunkin' Donuts, you're seeing signs up that say, starting pay rate at $13 an hour, $15 an hour. These are wage rates that are 20-30% higher than they were, pre-COVID. Mm-hmm. So it's sort of a little bit of a test case on, when employees go back to work, we could also be seeing one of the largest, real wage increases that we've been able to see in the last, couple decades. So I think it's something where even if inflation does run away and interest rates rise as a result, because the Fed's slowing things down, you still will have, because of the effect of the stimulus and supplemental unemployment benefits, employers are going to have to pay more. There's going to be more wages, which will ultimately then downstream to being able to pay higher rental rates and rent inflation. So do I think it'll be a perfect way out of it? I don't know, but I think there's certainly going to be some sort of a balance. And again, to the same point, I personally think it's healthier than it maybe could be. There's definitely a sense of fear. We do a lot of bridge lending. We look at pro formas, and some of them are very sensitive. What if rents don't go up by 3% a year, like every pro forma that we see out there, at a minimum? It's just one of those things where, then you stress your exit, interest rates, and does the deal still work? But it's one of those things where it's impossible to predict. So
we got into multifamily development because I look at it as the safest bet. Like, people are always going to need a place to live. Their mortgage, their rent, whatever it is going to be that first check they cut.
Yep.
And even more so on the affordable side, like, I feel like it's recession proof. Like, there's such a demand for it and not enough supply. Like, I think for many, many years, the affordable word just had a bad stigma to it. And now people, at least here on Long Island, are now understanding that, like, this is, my father or my mother who's, downsizing or just got divorced, or this is my kid who just graduated college, or these are firemen, these are nurses, these are normal people. My sister lives in an affordable unit in New Rochelle, and people have now understand that, like, we need this.
Absolutely.
We need this bad. So talking further about some of the products you guys offer, you guys do bridge lending as well. Just for the listeners that really don't understand bridge lending, dive into that a little bit for me.
Yeah. Bridge lending is a big term. But in its simplest form, it's a short-term financing tool for a property that's in transition, which it's not quite ready for Fannie Mae and Freddie Mac, which are predominantly permanent, long-term financing vehicles. Bridge is there for, say, you buy something that's maybe distressed, underperforming. Maybe it's not 90% occupancy, which is the big threshold for the agencies from a physical occupancy standpoint. So you get into a deal, let's say 70, 80% occupied, and it has a value add component. Say you had something that, hey, I'm just a better operator of this building. I could run this at 95%. Maybe I have a portfolio that is in the same market. I have a property down the block that's getting higher rents. That maybe it is occupied, but somebody is, maybe a little less sophisticated, or it's a legacy owner that just hasn't pushed rents and doesn't really need the incremental cash flow. Doesn't want to put the capex into the building to upgrade the units to unlock that, additional value and unlock those rent premiums. So what we do is, we work predominantly with folks who are proactive, and active, investors who try to create a business plan for an asset to reposition it, take it from a C-class property to a B-class, or a B-class, to an A by, offering different kind of amenity packages. Maybe it doesn't have a pool, they want to put one in. Different things like that. There's a whole number of different business plans. We do anything from, sort of, repositioning of, a lot of things that are going to start hitting hitting a lot of bridge lenders' desks are a lot of these, hotel repositions, these smaller kind of, limited service hotels that just, were decimated by, the COVID situation. We'll look to transition to multifamily. That's a strategy, that I don't think we've had much appetite, because it's still generally unproven. And a lot of those, we look to our existing originations, on the Fannie and Freddie side to drive, what we're doing on the bridge side, right? So you want to have a proven strategy. A lot of those hotel conversions haven't been really proven yet, because a lot of them, these are, your average hotel.
Concept, yeah.
It's a newer concept, right? There's the footprints of the units are much smaller. So, some of them could be more sort of micro units, and can you really drive the rents and can you really retrofit a hotel to be a traditional apartment building? Some of them, I can imagine, are being done successfully. Where I live, I know one was done in Edgewater, as Sheraton was converted successfully. So those are sort of the bridge type plays that we focus on in multifamily. Like I said, it just could be underperforming. Could be something that, I'm doing one now in South Atlanta that's 95% occupied, but it just, you put some real dollars into the units, upgrade the appliances, put new flooring, put new cabinets, just give it a refresh, some exterior paint, siding, whatever it may be, some landscaping, new signage, rebrand it, give it more of a sense of a community. Some of these, well-performing properties, just, you can breathe new life into them, and then, the financial performance then follows. And, we underwrite to basically an exit, which is, what is your cash flow going to look like, 36 months from now? Or if it's underperforming, if you get it back to market, what does that look like in terms of our ability to finance it on perm? And we look at the strength of the sponsor. Have they, done projects like this in the past? Have they done them successfully? How many have they done? And, that's sort of, we use a risk-based, sort of pricing model around that. And it's ultra competitive. We've been one of the biggest producers of bridge, debt out there.
Now, can that bridge debt also, say you're given 70-30, right? And the sponsor has a gap there. Can't that bridge kind of fill that gap as well?
Yeah, absolutely. Our platform actually will go as high as 85% of cost,
Okay.
and that's purchase price plus your capex,
Okay.
and then we hold back capex from that. So it's originally funded from equity, but it's it's there for distributions, post work completion, lien waivers. So we do go pretty high up on the stack, and we price for it.
Yeah.
So we have higher leverage products. So whether it's mezzanine financing that sits over our senior, or we do sort of a blended kind of stretch senior, which is just higher leverage, higher priced senior.
Great. I guess finishing off, where do you see the market going? What are you excited about? Is there anything new that's out there that you're just you're really pumped about? Like, what's in the future for you?
I'll be honest, that's a tougher question to answer, just because every single day you just see something new every day. There's constantly, new investors coming into the market, figuring out, how to get deals to work. You're constantly, working through different innovations, with new products that come out, with the agencies, over the last kind of year and a half. Like the biggest thing was these pricing incentives that Fannie and Freddie put out for in exchange for, say, manufactured housing communities to just restructure their leases to offer some site protections to their tenants, which made them generally affordable. But you saw discounts to great pricing at like 40 basis points. So little innovations like that are always keep you on your toes because it has a dramatic impact on how much business you can do. And not only that, that's obviously from a selfish perspective, but it has a real impact on these communities and the and the tenants. And that's the most important thing. It's what I'm excited about is the ability to continue to work for an enterprise that is constantly, putting capital out to workforce housing communities, trying to solve for that affordable housing gap. Perennially we are Fannie's largest workforce housing lender by unit count. And we've been so probably for the last 5 years at least. So that is something that I kind of take to work every day and is exciting. And I will be doing this probably for the next at least
Forever.
10 years. It's always fresh. It's always moving. There's I think look, if 2020 taught you anything, there's always something that you haven't seen before.
Absolutely.
And I think that is always going to be what's interesting. And I'm sure it just the same, in your experiences as a GC and now a developer. You're always evolving. You're always trying to figure things out, and there's always a challenge.
Every day is a new
for.
challenge. That's what gets me going is the fact that I don't know what today's going to bring, and we're going to solve whatever problems we have to, and we're going to persevere. If somebody wants to reach out to you, where do they find you? How do they get you?
I'm all over the place. You can find me on social media, predominantly LinkedIn. You just search by my name and Arbor Realty Trust, and I'm out there. Otherwise, you can get me at awalker@arbor.com.
Awesome.
And that's it. And I'll respond.
Great.
In a hurry.
Always good to see you.
Likewise.
Really, thank you for coming on.